for people who don't know, like we haven't revalued council tax since 1991. That is just embarrassing and ridiculous. Like nobody thinks it makes sense. I mean, the most amazing part of it is that when we build new houses, we have to try and guess, like, what do we think this house would have been worth in 1991? Which is just a stupid question.
Hi, I'm Ravi Gurumurthy, CEO of Nesta, and we've got Arun Advani here in the latest in our podcast series, What Can Andy Burnham Do? And we're going to be focusing today on the big question of taxation. Should we raise capital gains tax? Should we change the way we tax property? What can we do to tackle the cliff edges that exist that create weird distortions? We're also going to be talking about what it means for devolution. What would a tax system that embraced devolution look like? Arun, welcome. Thank you for joining us.
Oh, thanks for having me.
So we're going to talk all things tax and what Andy Burnham should do. Let's start with one of the most often suggested taxes, which is a wealth tax. The Greens in particular have suggested it. I don't think you think that there is a viable wealth tax that a government could do that's either desirable or feasible, but just outline what are the typical options that people talk about and why they're not possible.
So when you talk about a wealth tax is saying, let's add up the value of all of the stuff that somebody owns. So their house, if they own it jointly with a spouse, half the value of the house, take off the mortgage, the value of their pension, value of any money they have in a bank, if they have any stocks and shares, add up all of those things and then draw a line somewhere and say, if their wealth is above that line, then on the bit above that line, let's tax that. So for example, a policy that's been floating around for a while is some people calling for a 2% tax above £10 million. They're saying if you have £11 million, you're paying 2% on just that top million. So if you look at around the world, what do wealth taxes of this sort look like? They've tended to be a relatively low threshold. So, a threshold that in UK terms is like £100,000, £500,000, those sorts of thresholds. That covers a very large share of the population. And the impact of the choices that other countries have made when they have these low threshold taxes is that because there's so many people who are covered by the tax, you have to keep the valuation of all these assets simple, right? You know roughly the value of your house. We don't know exactly the value. You know roughly the value. You could get information on the value of your pension, but these things, eventually add up to being complex. Particularly what's complex is the value of the business. So if you're a plumber and you're running a small business, or you're a hairdresser, you're running a small business, you have to work out what's that business actually worth if you sold it to somebody else. Often not very much, but you still have to work it out. And so to solve the complexity that comes in here, countries have taken shortcuts in how they value things. So they say, okay, we'll value the value of a plumber's business at just what's the value of the tools that he or she has and the van and those things. And for a plumber, that's basically right. In a world in which they sell their business, if they're the one person running the business, once they sell it, all it's worth to somebody else is just the stuff. The problem is that when you then use that same method for valuing the value of a business that someone very wealthy has, that's like nowhere near the value of the business, because it's not the computers and the tables and the chairs that is what makes a big business valuable. It's often the know-how, the client lists, the kind of special IP that they've built up. That's really where the value is. And so taking these shortcuts means that wealth taxes aren't very effective when they're designed in that way, at taxing the very wealthiest. So the alternative at the Wealth Tax Commission, which I ran with Andy Summers and Emma Chamberlain, that we talked about was you could instead, if you wanted, have a wealth tax starting at a much higher threshold, say £10 million. Then you have a relatively small share of the population who you're covering, and you could then afford to do very high quality market valuation. It's not easy, it takes some work. You can do it. No one should pretend it's going to be simple. No one should pretend that you're not going to have some avoidance behaviors. We estimated that, maybe 17% of the expected revenue you'd get if nobody changed their behavior would be lost due to changes in behavior for a 1% tax. So that's the way to think about it. You can definitely deliver it, but it will have some costs. It will also take time. It takes a few years to build a new tax like this. We don't currently know who owns what shares, what properties, what businesses in an effective way. So you couldn't implement.
And it takes time just because the actual valuation process would be.
Valuation takes time. You literally just need computer systems to do it and forms to do it. And those things, they seem really boring and processy, but you need
Can't AI sort of solve this for us?
AI can make some things a bit easier, but it's not going to create the computer system. Like, it is a thing that is a barrier. And so particularly at the moment in these discussions that are going around, should Andy Burnham create a wealth tax now? He's not going to have a wealth tax that gives him any money this side of an election. And so if he really wants to try and do the work for it, he certainly could try and do the work, but he shouldn't expect any revenue from it this side of an election. And that's just the trade-off is, do you want to burn political capital on that when there are other taxes on wealth that we have, like inheritance tax and capital gains tax, that could be improved, particularly capital gains tax? There's lots of scope for improvement.
And in terms of the amount you'd actually raise if you went for this tax on assets above 10 million pounds.
Yeah.
What kind of estimate do you come up with?
So the Wealth Tax Commission, which we were running back in 2020, we said a 1% tax on assets above £10 million would be taxing at the time about 22,000 people, but it would raise about £10 billion. So you're not going to pay for the whole NHS budget on that.
And that's a one-off.
That's an annual tax. That's a recurring £10 billion a year.
Mm-hmm.
And that you should think about as like 1.5p on standard rates of income tax.
Mm-hmm.
Now wealth has increased a little bit. We think maybe it's about 12. I mean, the data that we were using to produce those estimates, the ONS's version of those data have kind of declined in quality. So it's a bit harder to know now exactly what the number is, but we're sort of talking 10, 12 billion pounds after accounting for behavioural responses every year.
And those behavioural responses, how did you get a handle on how big or small those are? That must be pretty difficult to estimate.
Yeah, so we couldn't estimate it directly for the UK because we don't have a tax like this in the UK. What you can do is look at figure out what are all the things that people can do, and then look at what are the scale of those responses in other countries where these things have happened. And it's worth saying that that's kind of estimate of, you lose about 17% of the revenue. That was even after you do a lot of fixes. So there are things in other countries, often the loss is even larger than that because they've made bad choices. So one bad choice is to not value some asset classes. So in some countries, they say main homes, they're just exempt from the wealth tax. The problem with that is then, of course, people spend more money on their main homes than other assets, right? Or you say, let's take a shortcut and value private businesses at a discount. You work out the value of the private business and we'll tax half that value. Well, suddenly my private business turns out to own a lot of my stuff because having it inside the business gives me a 50% discount. So I put all of my stuff inside the business instead of owning it personally. Mm-hmm. So you get these kinds of problems that cost you a lot of revenue. In Switzerland, the tax has been designed in a way that's very local by canton, which is actually quite small. And so people move cantons because just moving just across the border can reduce your tax. And so when those changes that you need to make in your life are quite small relative to the tax impact, you see quite a lot of impacts there. In the sort of best case scenario where you don't make those bad choices, there are things you still can't stop people doing. So you still won't stop the fact that in a world in which you put a tax, if I have £12 million, you put a tax on me above £10 million, my kids, I'm suddenly going to give some more money to. I was going to give it to them one day. I give it to them a bit sooner. Suddenly we're all below £10 million. You kind of can't do much about that. That's a totally legitimate thing. I'm obviously now genuinely don't have that money if I've really given it to my adult children. But at that point, clearly you're not getting revenue from me. And so we have to account for those sorts of behaviors.
Okay. Let's talk then about something else that has been dubbed a wealth tax, I think by Wes Streeting in his non-campaign, which is about CGT, capital gains tax, which you mentioned, the idea of indexing the gains, equalizing the rate between capital gains tax and income tax, and then to avoid the kind of behavioural responses you mentioned, your proposal is to have a death tax and an exit tax. So you can't basically leave the country or hoard your assets until you die. Now you basically think that's a good idea. I want to start by almost unpicking the effects for different people and what this does, because in a way there's three different segments I think. So one is that you've got people who get taxed unfairly because their asset has only grown with inflation and yet they're getting taxed on a nominal increase, and your proposal would fix that. Mm-hmm. You pay nothing if you in that situation. You've then got the problem of the solicitor who becomes a partner in a firm who then is sort of potentially being taxed, that their income is being taxed more as a capital gain, and people can shift things around, can't they? And therefore they're being undertaxed. They're not being taxed at the right rate when it's basically income. And again, So
just to give a kind of practical example of what you see with that kind of behavior, the kind of classic example, and you see this quantitatively as the large area, is classic management consultant, IT consultant. You work for a big company for a few years, you get your skills, then you go and set up a sole trading, like incorporated company as a management consultant, as an IT consultant, as a whatever. And then you get paid into the business. You keep the money mostly in the business, pay yourself a small salary, pay yourself some dividends every year because they're taxed at a lower rate than the salary would be. And then anything you don't need immediately, keep stored up inside the business. At some point you can liquidate the business and get that money out as capital gain. And that's basically work you were doing that should have been taxed at income tax rates. You're getting the much lower capital gains tax rate now, and no substantial investment was going into that business.
Exactly. But then there's a third thing, which is, let's say you set up your business, you're an entrepreneur, and you'd then be paying CGT at 45% or whatever. That would be quite a big shift. And the slight concern I would have is, does that not deter entrepreneurial activity? So, for your first two groups, great. You've solved those two problems, but how do you think about how to avoid deterring entrepreneurship in your CGT change?
A few different things to think about there. So one is actually our best evidence on what entrepreneurs, like genuine entrepreneurs, know when they're setting up businesses is they basically don't know much about what capital gains tax rates look like. There's some good qualitative work that was done actually by HMRC many years ago where they were looking at reliefs that they were giving entrepreneurs and trying to work out, did these entrepreneurs know anything about these reliefs? And they didn't know any of this stuff existed. They had no idea what the rate was. Many of these people are basically, I've got my brilliant idea. I really believe in it. I want to make it happen. Obviously I want to make a profit doing it, but I'm not really aware of what the tax status looks like when I exit the business. Right now, I want to build a business and make it successful. And for the next 10 years, I see myself running a business and making money through the business. I'm not thinking as much about the end state. Obviously, at the point that you've made a big business, you care that you want that rate to be as low as possible, but it's not a big part of what people are thinking at the start. So that's the first thing.
Although if it was 45% CGT rate, higher than any other country, presumably,
yeah, so
it might sort of it might be more.
Only if you know it exists, right? Only if you know how it's taxed. But yes, absolutely. So the second thing, to the extent you're putting capital at risk, you're going to be getting this indexation allowance, right? This investment allowance that's going to reduce your tax rate. Mm-hmm. If there's basically no capital in the business and what you're saying is, well, I'm just working really, really hard. I mean, yes, you probably are. Lots of people are working really, really hard. That's what income tax rates are for. Mm-hmm. Now, we might say that income tax rates are too high. Some people think that, some people think they're too low, but ultimately that's a different debate, which is like, what should the income tax rate be? But if you're working really hard to build your business, you're working just like lots of other people are working. Mm-hmm. And we can argue about what that rate should look like. It should be taxed like it's work. But you're basically, if you're making a profit on that business beyond just the returns you're getting on the capital, is either because you're incredibly hardworking, that's work and skillful, or it's luck. If it's luck, then there's not a really compelling case to give you a lower tax rate, or it's that you have some market power, monopoly power, like your business has cornered some thing that means you'll be able to make profits beyond everyone else can make. Again, in that case, there's not really a reason why, when you've got this market power, we want to be giving you a lower tax rate. Then third thing, if you really are still worried, if you're a policymaker and you go, look, I hear all that, I believe all of those things, I'm still just really worried about this. I really am convinced, despite the lack of evidence in this space. And I think the answer genuinely is not evidence to the contrary, but a lack of evidence. Yeah. We just don't know a lot about what this effect looks like in practice. These kind of people are few and far between in terms of setting up big businesses. It's really hard to get good quantitative evidence on the scale of the impact. If you're really concerned about that, what you should do is take a bad relief that we have, that's literally called bad relief. And it's a relief that exists that currently says on the first £1 million that you get of a private business you run, you get a special lower tax rate. That tax rate used to be 10%, it's now gone up to 18%. You get an 18% rate on the first £1 million, and then you pay the standard rate on everything else. Now, if you have a business worth £2 million, then getting half of the value of that business at a low rate, that's quite nice. If you're really building the next unicorn and it's going to be worth £1 billion, do you really care that you get a lower rate on the first £1 million? Not at all, right? It's just like not having any impact on the tax you're paying. So what you do is take that bad relief and flip it on its head and say, actually what we'll do is we won't give you any relief if you're building a small business. If you build a business that's above some huge size, that's really valuable, we think is going to contribute to overall employment, lots of people are employing people. Just saying I employ somebody is not saying you're creating jobs. When you're employing more people than would have had a job somewhere else, that's creating jobs. Mm-hmm. It's really hard to evidence when that happens, but plausibly for a very large company, you are doing that. So if you're building a company that's really large, say £100 million worth of company, then we'll give you a relief. If you build a company that's worth more than £100 million, and then you're selling some share of it, you might have sold bits of it along the way, but at that point you're selling out. At that point, we'll give you a special relief that gives you a low rate on the whole value. So sort of flipping the idea of bad relief on its head, it's giving you on an unlimited amount, only for a very narrow slice of people who are really building these giant companies. You could give them a special relief if you're really concerned about it. And that would be a way in which you kind of protect specifically that group if you're worried about it.
Okay. So in some ways, the cumulative impact of both those changes would be stay invested, build something big.
Yeah, if you're building something big and you're staying here and building it really big, then you're going to get a relief. If you build something that's small, then fine, great, you did it. But there's no big wider impact for the UK that we should be giving you a lower rate for.
Yeah. What about the other slight risk, I guess, is just when Nigel Lawson did this, it was in the context in 1988 of a tax cutting budget where top rates were coming down. If you did it now, on the top of all the other tax changes that happened over the last 2 years, there's a slight risk that from a vibe perspective, it just feels like, taxing wealth creation even more. Is that, I know it's an intangible, because I can argue
it's totally intangible, right?
Exactly. You might worry about that.
Yeah. So the best time to do this would have been yesterday, right? As in, like, to have done this, and to actually, I mean, the best time to have done it would have been at a time when you were pairing it with other things. I think you can say now is even this capital gains tax reform, the kind that we've just talked about, by giving an investment allowance, is giving you a lower tax rate if you're putting actual capital at risk, because it's bringing down the cost of capital, right? So that is encouraging investment. It's the people who are typically going to be taxed more. So more than half of current capital gains taxpayers are better off, or like no worse off, under this reform. The people who are paying more are the ones where there's very little capital in the business, and it's mostly this example of the consultants and that sort of person. They're the ones where the revenue's coming from.
Yeah.
It also raises quite a lot of money. So if you do this overall package of reform, you get something like £12 billion a year. And you could use some of that money towards other things that are pro-growth. So that could be giving to the British Business Bank to go and do investments. It could be through designing or increasing the size of existing reliefs that we have. You know, you can think about what the best way is to support growth with that. But that might then also send the signal that, look, what we're doing now isn't a capital gains tax policy in the end that's pro-growth. What we've got is a capital gains tax policy that's pro-shifting income between different sources, not one that's pro-growth.
Yeah.
What we want is one that actually is genuinely giving you compensation. This design isn't even one that's actively compensating you for capital risk. It's just getting rid of the disadvantage on capital at risk at the moment. And so by giving an investment allowance that protects that capital and says, look, you can make a certain return on that, that is at least what you would have got by just sticking it in a bank. And we're not going to tax that. We're only going to tax you if you make more profit than that. And at that point, we'll tax you like everything else. That's actually good for growth in that sense. And you could spend the money on other things that would also support growth and would then go, I think, would pair well with a sort of pro-growth vibes budget.
And the £12 billion figure is you know, is a very material amount that you could raise. I've heard sometimes the Treasury internal estimates on this change being lower than that.
Yeah, I mean,
do you know why that might be? Are they assuming some behavioural response that you've not accounted for?
So I think it's really about what package of reforms you have. So I think the number that people throw around a lot is that you lose money on no reform that just increases the tax rate. I think that's probably right. I would not start from here and say, let's just increase the tax rate. That is definitely bad for growth. It's definitely bad vibes. It's definitely, well, nothing's definite, but it's highly likely to cost money because people are going to respond in ways that don't support more revenue coming from capital gains tax. But the point is a package reform that is saying, look, we're going to actually reduce the cost of capital for people. We're going to actually reduce the tax rate for more than half of current capital gains taxpayers. And the ones who are going to pay more are the ones who are not actually putting capital at risk. That is a way in which you can actually raise money from this reform. And I think basically it's about costing two different things. I think costing just a tax increase, plausibly you get to the point you're actually getting lower tax take. Costing it with these other things that actually both reduce some of the ways in which people avoid the tax now. Currently, there's a very strong incentive I have for if I've, you know, in my 70s, 80s, I've owned some assets for a long time. I could sell them. They may not be invested in the right thing now. I might want to sell them and buy something else. I think an AI firm is the next big exciting thing, or some fintech. But I've had these shares for 30 years. And if I sell my, you know, Bradford and Bingley shares of 30 years to try and get something more exciting, by doing this, I'm actually going to have to pay a big capital gains tax up front. It's not worth it. I'm probably better off having the capital gains tax written off, which is what happens when I die. Or I built a huge fintech firm. You think of examples of this. I was worth many billions of pounds. And actually, I would like to build my next business here and I'd like to do more stuff. But if I sell my company while I'm here, I'm going to have to pay a 24% rate right now. And I could just move to Dubai and there's no charge on settling up, right? I've used UK resources. I've spent time here. I've used all the benefits of the UK to build this. And the UK is saying, I'm going to tax you, except if you leave. If you promise to leave, I'll give you a 0% rate, as long as you promise not to come back for 6 years. That's what we do right now. Obviously, if you say we're going to tax you, except if you leave, lots of people take that incentive seriously and say, oh, well, I'll choose to leave. So again, if you shut down those kinds of margins and say, look, we're not trying to tax you for exiting, you're welcome to exit, but you will have to settle up the tax bill you owe on the gains you built up while you were here.
Yeah.
You know, it's sensible that we allow you, unlike income, where we tax you every year, to defer the tax on the gains you're building up until the point where you sort of realize it and you get the money from those gains. But if you're leaving the tax system, it makes sense to say, look, before you leave, you do have to settle up and pay your restaurant bill for having been here and eaten this meal, right?
And other countries do that.
And other countries do that. Yeah, we're one of the only 2 countries in the G7 that don't.
Now, just so you've now raised £12 billion from this change. What would be the most pro-growth way of spending some or all of that £12 billion?
There are
on tax changes.
Yeah, exactly. In some sense, it's not even obvious that tax changes are what you want to do, right? Like one answer to that is there are actually lots of places where we know there's a return to spending and you might want to do some of those things, right? Like the state of transport in this country, or the potholes, all the things that people complain about. Like, in some sense, they're micro. In some sense, actually, if you think about the delays that they cause to people, the damage that they cause in various ways, like there are benefits to spending on some of those things. I don't know which of those things is sort of the highest value to do within the space of tax. I think actually the CGT reform overall is a good reform, even before you think about how you spend that money. I would definitely, once you do that, the sort of the fifth limb of that reform is also be more generous on losses. People who invest really might make losses. Why can't we be more generous now on losses? Well, we can't be more generous now because what we don't want right now is you to build a...
And just explain what the generous treatment of losses
right,
is.
Exactly. So right now, you might invest in something. You've got your money, you put it in a few different companies you think might be good. Some of them do well, some of them do badly. Right now, we'll let you offset the losses you make on some of the companies doing badly. So you lose some money there. We'll let you offset that against some gains you make. So you bought 2 companies for £1 million. One of them went down to 0. One of them went up to £2 million. You're flat, right? You made no profit. We're not going to tax you because you can offset the loss against the gain. That seems quite legitimate. Suppose you only invested in one company and it happened to lose money. Now you've lost that £1 million. You actually have your income. We could let you offset against the income you're getting because you are worse off, right? So we could say you tried, you invested, turned out to fail. Let's offset it against your income. Why don't we do that now? We don't do that now because suppose you did invest in those 2 companies and you made the £1 million loss and the £1 million gain, and you didn't sell the company with the gain. You sold the company with the loss, or you lost the money, and you declare the loss and you take it off your income tax. So you have much less income tax to pay for the next few years. And then you leave the country. And then you sell the company with the gain and you've got all the money, and we can't do anything to deal with that right now. Or you hang on to all the ones that do well, you hang on till you die, and there's no capital gains tax. And all the losses you harvested, you use all of them to offset your current tax bill. So the choices we make now, where there are some ways in which you can get some gains out of the system, mean that we end up being overly punitive on losses.
Okay.
If you're better on losses, and then that's why other countries actually, like the US, lets you offset your losses against income tax. Why can they do that? Because you can't leave the country without settling up your capital gains tax bill. And those things just have a useful impact.
This CGT change is part of a sort of wider principle about trying to make sure that you pay the same amount of money wherever you earn it, whether you're, Now, there's a similar principle you could apply to national insurance contributions, couldn't you? So some people end up
paying national insurance, and some people don't all pay lower.
So perhaps give us the examples, and then what could we actually do about it?
Yeah, so a couple of really striking examples. One that I always find sort of the most obvious is someone working full-time on the minimum wage is paying income tax and paying national insurance contributions. They then go home and pay rent to a landlord, and the landlord pays income tax and no nicks. And that it's hard to rationalize why would you want landlords to have a kind of lower effective rate in that sense for the same level of income. Another one that just is very odd is if you're a solicitor or an accountant working in a partnership and you're a sort of junior, you're working as an employee and you pay income tax and nicks on your income. One day you get promoted to partner and that's like a big success. You're getting a pay increase and the nicks disappear. You're only now taxed income tax. There's no nicks on your partnership income. And it's just a very odd situation that exists for historical reasons. Historically, also national insurance contributions just weren't as large, so it didn't make as much quantitative difference. Now it really matters, and so it changes how companies structure themselves. More companies are structured as partnerships, specifically because they want to make use of the fact they can then make lots of people partners and not pay nicks.
And are partnerships less productive forms of economic organisation?
Well, one problem with being a partnership structure is you don't have limited liability in quite the same way. You can have limited liability partnerships and they can have limited liability, but lots of them are general partnerships. They don't have that. And limited liability is important because I can afford to take risks in a world in which I'm not going to have someone come after my house. That just goes wrong. The other thing is that partnerships end up finding it harder to own assets, sort of owned in a corporate way, right? Effectively, the partners themselves have to own the assets, and that becomes quite messy in how they invest. So it does actually make it harder for them to invest in practice.
Okay.
And then there are additional, because HMRC, you can see that this is obviously a bit of a wheeze. I could try and set up a partnership that's really a company, but using a partnership structure. There's a whole load of anti-avoidance provisions. So sometimes we talk about simplicity. We have reams and reams of legislation that's trying to stop me setting up a kind of fake partnership. And so then I've got to meet all these rules and it's just complex for everybody. And it's really hard to see how that's helping anyone.
Okay. And how much would that raise then if you extended nicks?
So extending nicks to partnerships raises you a couple of £1 billion. So again, not life-changing, but definitely useful.
And Rachel always tried to do it and then backed off because of...
I mean, there was some reporting that she was thinking about extending it only to limited liability partnerships. It's a bit odd. I mean, if that was what was happening, and I don't know if that was, that would seem like an odd reform to do because that would only some of the partnerships that are out there. The problem is equal for all of the partnerships. And you definitely want to extend it to all partnerships if you're doing it, because otherwise, again, people have incentives to change what form of partnership they're in. Going back to the sort of landlord's example, if you were to have, equivalent of national insurance contributions on landlords, you raise something around £3 billion from doing that change.
Okay, so if you did it across those
annually, doing the two of them annually gives you £5 billion roughly.
So, okay, so we're up to £17 billion in your
exactly.
If you do both of your changes. Let's talk about you talked about simplification. One of the things that people always complain about is cliff edges that exist. If you started to spend a bit of money on reducing or sort of tapering those cliff edges, how would you do it?
Yeah, I mean, one of the most egregious cliff edges that people end up talking a lot about is the cliff edge at £100,000. Now, that's a pretty high level of income, right? Like most people are not anywhere near that. But
does it really matter? Does it really matter?
Exactly, but it doesn't really matter. I mean, in some sense, it is important. And like as a principle, it's a bit odd that you'd want people. Well, what happens? So let's explain what happens now. What happens right now is if you have young children who are pre-school age, so they're sort of nursery age effectively, so 9 months to just under school age, you can get 3 hours of childcare. The government gives you 15 of the 30 hours free childcare. That depends on your income staying below £100,000. And so you go just over £100,000 and suddenly you're going to lose all of that free childcare. And that free childcare, especially if you're in the London and South East, is very expensive, but across the whole country, wherever you are, losing the entire value of your childcare for going £1 over £100,000, you're definitely worse off. It's kind of crazy. It's increasingly a problem relative to where it used to look like 5 years ago, because the expansion of free childcare hours means that there are more of your kids might be covered at any point in time. Mm-hmm. So the loss for going £1 over 100,000 is much larger than it used to be. There are also more hours that you get. It's also the case that childcare has become more expensive, and so the loss is even larger in that sense. And with all of those things happening, that cliff edge at £100,000 has stayed at £100,000 since 2017. Mm-hmm. So more and more people are affected by that cliff edge because more and more people are getting towards £100,000. Still clearly not most people, but it is still there as a principle. It's a very odd one to have that kind of design.
Yeah.
So what could you do? You could, I mean, in the simplest world, if all you want to do is to make your life very easy, you could just move where that cliff edge is. That would still be a cliff edge, but it would affect fewer people. Better would be to design a taper that would taper away the value of the benefit. So rather than losing all of my free hours for going £1 over, what we do is you lose a bit of the hours and you use a bit more, you use a bit more. Mm-hmm. You know, it is a hard policy to administer, it's worth saying, because what we're giving people is the value of a certain number of hours of childcare. Depending on where you are in the country and depending on how many children you have, the value of that benefit is different for different people. Okay. So it's not a trivial thing to do, because someone, living in the Northeast with one child under 5 is going to be a much lower benefit than somebody of the same age with the same income, but who lives in London and has, 2 kids or 3 kids under 5. And so you do have to think, how do you design a taper that isn't crazy and accounts for both those two different circumstances? So, we've got some work on this at the moment that will come out in a few weeks, but you can design things that deal with this problem, and whichever solution you design, it will be less egregious than the current cliff edge.
Okay. One of the challenges that the government faces is that the manifesto stops it raising taxes on about 3/4 of the tax revenue because of the commitment on things like VAT and national insurance and income tax. One possibility, though, is reforming property taxes and getting rid of council tax and stamp duty and replacing it, for instance, with a proportionate property tax or land value tax. Can you just talk us through what proposals do you think would work, and particularly what is viable within this time period as well? Because some of these things are incredibly complicated to actually administer and value houses or value land, etc.
Yeah, so there's a few different things to think about in any kind of reform in this space. So the first, for people who don't know, we haven't revalued council tax since 1991. That is just embarrassing and ridiculous. Nobody thinks it makes sense. I mean, the most amazing part of it is that when we build new houses, we have to try and guess, what do we think this house would have been worth in 1991? Which is just a stupid question, right? Why don't we just look at what it's worth now? That's more helpful.
I'd forgotten about that weird anomaly.
It's insane, right? So revaluing that stuff, totally sensible. Some houses have increased in value more than others, so completely logical you'd want to do that. That kind of process takes a couple of years, typically. I mean, there are already plans to do something of a revaluation, because at the last budget, Rachel Reeves introduced this high-value council tax surcharge, which works a bit differently to council tax, but in the end is trying to value properties. Yeah. And so you could just extend that process to all properties. I mean, Wales did their revaluation, now a bit more than 10 years ago, but they did it in a couple of years. So you could do something like that. That would be very sensible. A different thing is, do you want to move the tax base from the value of the property to just the value of the land underneath the property? Just administratively, that's a bit of a pain, because we see lots of sales of houses. So you can kind of probably guess the value of your house. Like, you know what you bought it for, you know what your neighbors on the street sold their houses for recently. You kind of know that neighbor's house is a bit nicer than yours. That's a bit less nice. I'm probably in between. So you kind of have a sense for what that looks like. What's the value of the land under my house? I don't know. I have no idea what the value of that bit is separately. So you can estimate these things, but it feels less attached to what you kind of know about.
And that's obviously contingent on the planning permission that exists and whether you can extend it and all that kind of thing.
There's all kinds of things that interact with that. I think there's a different important thing that we need to think about in the context of these reforms to council tax. So reforming council tax in the sense that you reband people's houses, straightforward. Then there's a question of, do you want to move to like what is overall more like a proportional tax on property? So at the moment, what we do is we have taxes that vary by your local area, and houses that are typically houses that are in lower wealth areas of the country. So roughly the north of the country and the sort of west of the country have higher tax rates effectively than areas of the southeast. And the reason for that is because if you're in Westminster, you need to pay for social care and all these other things. And if you're in Burnley, you need to pay for those things. But in Westminster, houses are worth a lot. So you don't need to have a very high rate on those houses to be able to raise the money you need to pay for the things you do.
And Westminster gets loads of parking tax revenue as well.
Yeah, the Westminster is actually a really special case for those things as well. Whereas, you're in Burnley, you don't have that benefit. So you're going to have a higher effective rate. So you could move to a purely proportional system. If you move to a purely proportional system, you raise much more money in the southeast, you raise much less around the rest of the country. Then you have a question, well, how do you keep councils afloat in the rest of the country? Because you've suddenly reduced massively the tax base for those councils. And the real problem for the current government there is how do you do that? There's an easy answer to that. We already have the Barnett formula that covers across the 4 nations of the country. How do we make transfers? You just build a super Barnett formula that deals with all of the 300-ish local authorities that you need to make transfers between. So you can do that. But the problem for the current government is at the same time, it's talking a lot about devolution. And so meaningful devolution, I think, requires local authorities to have some control over what they're doing and what their tax base looks like. And the reason for that is because when you say that you want them to plan for the future, that's fine. But in a world in which they know that after every election, a new government will come in and a new government might change what all the transfers are. And we have seen that. The current government changed the transfers the previous government made. Previous government had changed the ones that were before that. They've changed already the transfers that are happening. For as long as that's happening, it's very hard for councils to be sure what does their budget look like over the next 10 years. They only know what's happening from now to the next election, and then things might change. And so that's why you want councils to have some control over their own tax base, and property is classically the tax base that won't move anywhere. So it's the thing you want to give them control over. But if you're giving them control over their tax base, what you're saying is basically because that tax base, that wealth is worth less in the north of the country, like land there is cheaper or properties there are cheaper, they are going to always need a higher rate. And that's just a tension. There's no right answer to that. There's no economics tells you this. It's just a trade-off between, do you really believe deeply in devolution? You want the councils to have control. In that case, in the end, you're going to have higher rates in areas where wealth is lower. Or do you want a system that's purely proportional, in which case you could do that and make transfers? But at the point you're saying, look, we want a tax that's purely proportional based on the property values, there is a different question going back to where we started, which is, why are we taxing property wealth specifically rather than other sources of wealth, right? Like for the middle classes, property wealth is the wealth they have alongside their pensions. For the wealthiest people, their wealth is actually not mostly in property or in pensions, it's in private businesses. Is there a reason you want to tax property wealth more than those other things? And there are some answers for that. You could say, look, property wealth is special. You can touch it, you can see it. It is the local tax base. Maybe that's why. Maybe it's because I get a consumption benefit from living in my house, right? If I buy other stuff, I'm having to pay tax on it, but I don't sort of pay a VAT effectively for living in my house. And so maybe this is a kind of pseudo VAT. Maybe it's because we're funding local services and we really want that to be on property. But you have to sort of engage with those arguments. And depending on where you land on those arguments, you end up in different places on how you want the reform to look like. But the kind of upshot is, for the current government, there is a tension between the devolution part and what a pure proportional system looks like. And at the same time, again, it's going to take a couple of years to do any version of this if you're doing the revaluation bit. So you shouldn't think of the impacts being this side of an election, much this side of an election. Maybe you still want to do it. There's a good case for doing it despite the fact that politically you get no upfront benefit. But the final thing is, politically, the other difficulty of something that's a pure proportional system is you end up, even if you do the transfers to make sure that councils don't go bust in the northeast, it's still the case that you have to worry about the fact that generally voters in the southeast are going to be paying more tax. And that just means you're going to have a whole area of the country where people are paying more. And in our electoral system, they may be less happy and be less willing to vote for your party. And that may not be offset by the benefits you get elsewhere.
Yeah, I mean, it feels like if you're going to do that, you do that in the first 2 years of an administration, not in the last year, which is when it would essentially
Well,
take effect.
exactly. So people are going to be really aware of it. It's going to be really salient for them just before you have an election.
I want to come on to the devolution question because fiscal devolution is something that Andy Burnham has talked about. Just on this point about fiscal transfers, it's always going to be the case, isn't it, that we have fiscal transfers in our system, given given the inequality we've got, and that's always going to add a sort of source of unpredictability for councils in terms of what they can bank on.
Yeah, so I think it really depends on what share of the council budget is the sort of unpredictable bit they're relying on government for, and what's the sort of local tax base. So in one in which you can get quite a long way on your local tax base, and the transfers are a important but sort of more marginal thing, that's a very different world to be in. To like most of this stuff comes from transfers, right? So in a world in which you move to purely proportional property tax, you are going to rely on a lot of transfers for large parts of the country.
Yeah.
And so there's just much more uncertainty that's going to come from that choice. And the other thing that we could do from the devolution perspective is actually do some undoing of something we've devolved, which is there's a lot of things, we say we want devolution. Part of the point of the devolution is that councils locally are responsive to their constituents and they can do things that constituents in that area want. But then we impose on them really large obligations of you have to deal with social care, you have to deal with other things that just are government mandated. You have no control over how you deliver these things. And there's not really a reason why those are the things that you want to be devolving. Like local government might be better at knowing actually what are the priorities in the area between parks and libraries, what are the priorities in the area about which roads to, retarmac sooner. It's probably not the place where you need to, it might be the delivery arm for social care, but it's not really the place where the funding for social care needs to come from. So actually one of the things you could do is to move some of the funding, Andy Burnham's talked a bit about this, I don't know what his plans are, but moving social care into the NHS type system, taking it away from councils to have to deliver that, because that's actually a huge part of what their budgets are now. And that would free up more of their budgets for the things that actually we really think they are going to be better at delivering.
Yeah, I mean, I think this is really, really important because I think we need to decide what is local government for and why you might have a principle of devolution for some services, whereas some, like National Care Service, you want to actually make more central. And if you think about, I know 4 things that local government does. It does stuff to do with safer, cleaner, greener, the local environment. It does stuff around economic development, transport and skills. And both of those, I think you could argue, should be funded quite locally. Certainly safer, cleaner, greener, that's how you win and lose elections. So there's an incentive to sort of pay for that. And there's a debate to be had about, well, do you want to pay more for more bin collections or more PCSOs? On local transport, again, it's a very local good. And if you invest in it, arguably you get the economic benefits, particularly if you localize some of the business rate revenue. But on things like children's social services, adult social services, those are things you're never going to get any electoral penalty for. So your natural incentive is probably to underfund that. And there's a good argument for it basically being nationally funded. It could be locally run, but with national targets and accountability. So if you went down that road of saying the area where we want the maximum discretion are the safer, cleaner, greener, and maybe the economic development side, and you should fund that. What would be the tax? What would be the tax base that allows them to make those genuine choices without?
I mean, so in some sense, if you had property tax being the thing that stays devolved, actually having more flexibility, because again, it's devolved but fake devolved, because we already constrain what the ratio is between band A, band B, band C. So you can't choose how progressive or non-progressive you are in the local area. You also can't change the rates very fast. So there's a cap on how quickly you can increase rates. Again, like if you think local government is accountable to local people, then why not let them make those choices, and they will be accountable to local people. If they increase those rates too fast, then people can throw them out. And someone else can come in and say, I'm going to deliver those services on a lower cost if I think I can. So I would give them much more flexibility in how they tax local properties. And then, and that could mean that the ratios between band A and band D are changed, or band D and band H or whatever. But then they because we're reducing the number of things they need to deliver, actually they could then focus on funding those things. I think the revenue, the current sort of base they have is sufficient in that sense, if the number of things they're trying to do is small. Part of the reason they're going bust at the moment is because actually so much of the budget is spent on not the safer, cleaner, greener, not the local education, where again, they might have a better sense. I mean, probably not local councils really, but like a mayoral authority level, they'll have a better sense of what does industry in their area need, what do we want local colleges to be training people in and making sure they're linked up with the local businesses to sort of supply the right combinations of skills.
Mhm.
Like, those things are actually better devolved, and you could fund those effectively if that was all you were focused on.
As we record this, it's being mooted that income
Income
tax,
tax is somehow going to be.
we might start with earmarking a certain amount to a given area. Now, that strikes me as it may be a stepping stone in the long term to something more significant, but I struggle to see how that can actually be useful because, firstly, what I imagine will happen is that the existing grant will just be relabeled as your portion of income tax. Then, if that income tax proceeds go up, okay, you get to keep it. But if it goes down, are we really going to cut your grant? I suspect at some point we'll end up doing some sort of equalisation to deal with your sort of Burnley-Westminster challenge, and then you've got the same basic system. It's just a
and I'm sort of not very pro devolution on something like income tax, because that does create quite strong incentives for people just to pick areas to live in. You can commute, but you live in an area that's going to give you the lower tax rate.
Yeah.
Right. And that, I mean, you do see that in other countries which have those sort of devolved systems for tax on something like income. You do get a lot of migration.
And then we underfund the sort of the centres.
Exactly.
And then commuter belt in the southeast is rich with lots of great income tax revenue.
So that's not really what we're trying to achieve. So I think income tax is not the base that I would choose to devolve at all. Really.
My colleague here, Tim Lernig, argues that we should devolve the more aggressive taxes like VAT or cigarettes and alcohol. I think. What do you think about that idea?
The thing about devolving, so obviously, we already know about people who will travel across the channel to pick up some cigarettes and alcohol on the way back.
Yeah.
In a world in which I don't have to go across the channel, I just have to go over to the next local authority or the next mayoral authority. I think there'll be a lot of car trips that are going to be just having a day trip out to the nearest town. Yeah. That's going to give you a tax break. I think you kind of can't in practice enforce something like that. Right?
What about business rates?
Yeah. So business rates. Again, government really hasn't decided what it wants to do with business rates, right? Like at the same time as we want this to be potentially somewhat devolved, we're making lots of new rules about actually which kinds of businesses do we like and do we not like. There's a reasonable case for some of those things. There is a reasonable case for saying, look, vape shops or whatever, or gambling shops we think have some negative externality. If you really think that, then, so often the argument is, if you change what taxes are that relate basically to land, that will fully end up being on the landlord. And so there's a sense in which some people, some economists will argue, look, that's just not going to be effective on having an impact on those kind of businesses. I'm not sure that's true in this kind of context, because if there's a trade-off between, look, as a landlord, I'm happy to rent the shop to either the newsagent or to the vape shop, but then the vape shop is going to have to pay a higher tax. That's not going to, then there is going to be that wedge between those two things. So I think there is a way in which you can make that effective. So if you really want to discourage certain kinds of shops, you can do that. There are other ways to do that, which will be through regulation, but you can do it through tax as well. So I think there's a case for doing that if you have the view that there are negative externalities or downsides of those shops existing, or too many of those, then you can certainly do something like that. But again, the question is I would say that if you're doing that, I would let local authorities basically make those choices. Mayoral authorities make those choices. Currently, we have a central government that's is planning new rules, as far as I can tell, around actually how those taxes are structured, so that which kinds of businesses I'm allowed to have in my local area at what tax rate.
What about, I don't know whether other countries do this, whether local government should just have a general freedom to establish any tax that they want over and above the national taxes. Does anyone do that? Because in some ways it seems almost a core question about who has the actual right to tax their citizens. Is it only central government?
In part, there's also just an information problem, which is, in a practical sense, even if we were to give local governments powers to tax income or something, I don't think we really want them to administer a separate income tax system and to have to actually collect information from people. So you need central government to sort of be part of that anyway. In the US, obviously state governments and local governments actually have sort of precepts effectively that are, they're not called precepts, but different rates. They add on surcharges, they add on to your income tax. So you can do that sort of thing. I think in the UK, starting from where we are, we're a very centralized system. I start with property. The other two taxes that I would devolve, I think you could definitely do something which has been talked about, sort of tourist tax, hotel taxes. The other one is cordon charges, so transport into and out of my city. It doesn't help rural areas, but there is a lot of externality that's caused by that. And that's also, cities and towns are dense areas in which bus networks can be effective. And you want to fund those networks. And so being able to say, look, a deal that we're going to give you, local population, if you choose to accept it, is we'll build a charge And if you cross this with your car, we're going to charge you something on it, like the London congestion charge. But all the revenue from that, we're going to plow back into making the bus network better for the people who now can't afford to use that. And actually, that can be a sustainable model that you get more people moving into buses or onto.
And can't they do that already with congestion charging?
They don't all have the ability to control their congestion charge. No, I mean, so there was London has that power. Not everywhere has that power. Manchester was given the option of that power pre its current mayoral system, and they didn't take it.
So just sort of winding up, last couple of questions. One is, if you could look abroad and steal anything from someone else's tax system, what would you import?
Oh, that's a really good question. I mean, of all the things, and we talked a bit about capital gains tax earlier, I do think capital gains tax, if you design it right, can actually be much better for growth than it is right now, and also can raise revenue. The most complex part of it is, if you were doing the full reform that we described, is how you deal with the sort of settling up bit. How do you deal with somebody leaving the country? And the closest to a good example you have for that is Canada. And Canada has a pretty good version. I mean, its version of capital gains tax is pretty close to sort of what I think we would want here, not all the way, but particularly on how it deals with that. I think it does a fairly effective job of saying, look, you can leave the country. If you leave for a little bit and you're coming back, you can just stay in the tax system. We're not going to charge you at all. If you're leaving and you're going to go away for a while, we're not going to tax you up front. You don't have to pay the money on the day you leave, but just like over a period, we'll work out how we get the money off you. So it's sort of like, it's worked through a lot of those issues, and it's sort of useful as an example for the UK because Canada, obviously historically was connected to the UK. And so it starts with a very similar legal tradition and a similar sort of tax system from way back. And so a lot of stuff from Canada can actually be imported fairly straightforwardly for us. I think the other thing that I would import is quite a different and not an area we've talked about, but currently we tax inheritances on the basis of when I die, we work out what was the value of my stuff and we tax that. Doesn't matter who it's being given to. If I have 10 children, you have one with the same value of wealth, the value to my children of what they're going to get is going to be much lower than what your child will get. But there'll be more the same tax paid on both our estates. Ireland has an example of capital acquisitions tax, which instead is a tax on the recipient based on how much they're getting. So it says, look, as a recipient of this money, from your perspective, it's basically free money that's arrived from somebody. We should think about that. It doesn't necessarily have to be taxed exactly like income, but we should think about how we tax that. And it matters, therefore, whether you're sort of 10 of you or one of you. I think that's a better design for how we tax that sort of transfer. It's also good because it doesn't have the problem we have in the UK, which is we have very strong incentive because of the way inheritance tax is designed, where it taxes all of the wealth that I transfer when I die, and all the wealth, to some extent, it taxes wealth transferred in the 7 years before that. There's a strong reason to try and start giving assets to my kids when I'm still 10, 20 years before I die. Capital acquisition tax just says, look, whenever my kids are receiving it, they're going to be taxed on it. And so it doesn't really change the timing of those incentives. And so I think that's a better design as well.
That's good, Andy. Okay, final question. What would you do if you're Andy Burnham in his first, well into now, his first 100 days, but what would you do in those first days to sort of signal the kind of tax reform that you want?
So there's a lot of different reforms you could think of for growth, right? So you could sort out the VAT system where currently only about half of stuff is being taxed to VAT, and so it creates all kinds of inequalities. You can sort out how we tax income from different sources, particularly income from work is taxed differently, as we said, whether you're working full-time as an employee or as a partner or as self-employed. You could instead look at property taxes. I think I would pick one of those things. Just pick which is the thing I want to solve. If I want to solve property taxes, let's take stamp duty, business rates, council tax, all of those things into the mix. Let's think about them all in one coherent way and fix that problem. If I really care about growth, I would focus on income from work and work out all the different ways we tax that and try and solve that problem. But I would pick one of those problems and say, look, these are all big knotty problems. We're not going to solve them all at once. But let's pick one area and really think about what does comprehensive reform look like? Not in we'll salami slice a little bit of it here and a bit of it there. And I think the reason that's important is both because you can't do it all, so you have to pick one thing, but also because if you really pick one thing, focus on it and work out what the design looks like, it means that the story you can tell at a budget is, look, we're trying to fix this underlying problem, and this is how we think we're going to do it. I hope you get it right, but it then looks very different. I think is genuinely different if that's why you're doing it. We needed to raise another few £1 billion because we promised something on defense, and we just had to put out of these, we went into the hat and grabbed a few things instead of saying, look, this is a good design. This is why we're doing it. This is what the structure looks like.
And one thing I would like is sort of almost fiscal forward guidance, where you say, okay, if my headroom has gone down to below X, the first place I will go and get more money or cut spending is X or Y, and the second place is this thing, because you just end up with this horrendous speculation all the time. And I think it'd be quite useful for people to have a sense of there's an automatic
Yeah.
They understand what's going to happen. Now, obviously, there are some things like CGT where you don't want to give it, you can't do that.
So
But
you have to be
all the other things, I think there's no real reason why we can't telegraph what we would cut or what would increase.
Yeah, and I think it's both that. It's also that when you are doing reforms, you might also think that some of the changes that would equal, let's say, the way you tax work, putting full nix on partners all at once, you might decide is a bridge too far. You might say, look, they have an unfair deal, we're going to fix it all at once. You might instead say, look, it feels too much to do it at once. So we'll telegraph and say, look, this is a problem. We're not going to solve it all at once because it feels like quite a big change for you. So you'll get this much in year 1, this much in year 2, and by year 3, you'll be equal to everybody else. And similarly, self-employed, we're going to fix that, the difference between taxation of self-employed and employees. But we'll do that in steps, and we'll show you what that plan looks like. In 2010, the coalition government did something like that for corporate tax, where they published a corporate tax roadmap, and it said, here are the parts of it we're not going to change. Here are the parts we're going to change. Here's the timeline and plan for how you do that. So you could do something like that says that we've picked an area, we've really thought comprehensively about what we think the system should look like, and we think the changes that we need, maybe just administratively are too big, maybe we think just for people's own lives they're too big. So what we'll do is get there over a period of 3 years, 5 years, whatever, and here's how we're going to get there, plot that path out so that everybody has the understanding and the certainty of how we're going to get to a better system and what the story is for why we want that system.
Great. Arun Advani, thank you very much for joining us.
Thanks very much.
Cheers. If you enjoyed this episode, please do like, share, and subscribe wherever you get your podcasts. We've got more coming. For those of you who don't know us, Nesta is a research and innovation foundation based in the UK. We design, test, and scale solutions to the big challenges of our time. We're funded by a charity endowment and are politically neutral. For more, do visit www.nesta.org.uk.